Welcome to the Savvy Investor, where it's our job to help you thrive in any economy. Allocation, allocation, allocation. Just like a successful restaurant having the right location, having a stress-free retirement means having the right allocation. Coming up, how to pick the right portfolio for you.
Welcome to The Savvy Investor. Each week, The Savvy Investor helps viewers just like you create and grow wealth, protect and preserve it, and distribute it in the most tax-efficient manner while alive and after you have passed. Our goal is to make you a better informed investor that hopefully leads to better results, but certainly less risk along the way. You can have financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your retirement forever. And now, The Savvy Investor with your host, Michael Canet.
Back in the 80s and 90s, an investor only had to open up the Wall Street Journal and randomly pick a stock or a mutual fund, and they probably did pretty well, performance-wise. That approach certainly has changed over the last 15 years. Now, everywhere we look, there are advertisements about long-term performance and historical returns. You can follow the green arrow into retirement. You can go to places like Morningstar, and they're going to tell you all about mutual funds, stocks, ETFs, and even about bonds. Almost every radio station across the country has at least one show telling you the latest, greatest product to buy or invest in. Magazines and journals all take the time to tell you about the next best place to put your money for the next 5 years. It kind of reminds me of that next shiny object, or better yet, a dog chasing a ball that gets distracted as a squirrel runs across the field. Unfortunately for the dog, he doesn't catch the squirrel and he doesn't get the ball. And unfortunately for many investors, there are so many choices and approaches, and quite honestly, the next best thing, they wind up doing nothing, the proverbial paralysis by analysis. Or worse yet, they try to do a little bit of all of it. So what ends up happening here, and we've addressed this on other shows, is these are the investors that sell low and buy high. They're the ones who end up with 3.5% returns instead of the historical averages of 8.5%. Today on The Savvy Investor, we're going to show you how to construct a portfolio, some of the analysis that is needed, the risk factors you may want to consider, how to protect your equities from extreme volatility, and how to allocate to give you the greatest chance of having a successful retirement, all while taking the least amount of risk necessary to accomplish it. Now, before we address this problem, let's take a look at what's in the news. One of my favorite pieces comes from Kiplinger's magazine, and it says, "Stocks on my short list. 10 worthy investments for 2008. These are culled from some of the best stock pickers in the industry." Now, from 2008, February 2008, some of the best picks, well, they suggested Air France. It only lost 65% during the crisis. CarMax, it lost 50%. Merck, 65%. Now, Coke, it was only down 23%. Now, these are worthy investments in 2008, and the best was down 23%. How do you feel about that? Now, from Google search, how to allocate your portfolio for retirement. Our team here looked up on Google how to allocate, and this is what it came up with. 3,760,000 results. That's almost 4 million hits. Imagine doing that research trying to figure out how to allocate your money. Our last piece comes from Forbes, the 7 Deadly Investor Sins. This explains that every investor makes mistakes, and while some are relatively harmless, others have a potential to be disastrous. The number one sin? Inappropriate asset allocation. Now, I think we all understand the notion of asset allocation, and it makes sense. Diversify your positions along various asset classes. It will reduce your overall volatility and give you the best chance of returns. Asset allocation is the basic tenet of modern portfolio theory. The problem is that we aren't all allocating. The problem is that there's so much information out there, you almost have to spend your entire retirement just doing research just to figure out how and where to allocate. And maybe, and just maybe, the allocation this year should be different than what the allocation was last year. Buy and hold doesn't mean buy and hold the same thing forever. Even Jack Bogle, founder of Vanguard Fund, says that. The positions you held when you were 30 and 40 years old are probably not the positions you should be holding today when you're 60 and 70. And after all, how many of you see a pediatrician as your primary caregiver? Today on The Savvy Investor, we're going to narrow down those 4 million Google hits and try to give you a concise approach for allocating your portfolio. You're watching The Savvy Investor, and we'll be right back.
Call for your free retirement guide at 1-800-787-SAVVY.
Want to lower your taxes by as much as 25% this year? If you think Uncle Sam is taking too much of your hard-earned money, it's time you did something about it. Our specialists and attorneys have over 100 years of experience helping hardworking retirees just like you. For a limited time, we're giving $99 income tax preparation appointments to everyone who calls and mentions this offer. Our licensed team of professionals can help assist you with sound tax planning, financial planning, and investment management. Taxes are too important to let just anyone prepare your returns.
Call ProStatus at 800-787-SAVVY or visit ProStatusFinancial.com to ensure you get all you've earned.
Welcome back to The Savvy Investor. Today we're talking about how to allocate your retirement portfolio. For many retirees, they segregate their portfolio into two categories. One that's going to be used for income purposes, and typically that money should be someplace safe and secure so that you don't have to worry about market fluctuations. And two, that portion is exposed to the equity markets. Now we're addressing that portion of your portfolio today, and I'm joined by CEO Jason Wink. He is the Chief Investment Strategist for Formula Folio Investments. Jason, welcome to The Savvy Investor. How are you doing today?
I'm great. Thank you so much for having me, Mike.
So one of the things, we're talking about asset allocation. Let's delve into it and explain to the viewers. I think people have an idea what asset allocation is, but let's talk a little bit about that as the precursor to our conversation today.
Sure. So the basic tenet of asset allocation is to not put all of your eggs in one basket. So if one asset, stocks, for example, is going up, perhaps you have bonds or real estate or commodities. If they're not doing so well, they tend to counterbalance each other. So the idea is that if you have a diverse portfolio, a lot of different things that perform differently at different times, the end result is a smoother line kind of somewhere in the middle. That's the idea.
So, like you said, don't put all your eggs in one basket. Sure. But there's a correlation issue as well, and that comes with what asset classes to buy.
Yeah, absolutely. So, I think that when people are putting together an investment portfolio, there's really two things that they tend to do. So one is they tend to build that diversification either just based on performance, probably a very bad way. In other words, they're going to look at
chasing returns.
Yeah, they look at the newspaper and they see, okay, here's the top 20, mutual funds or something, and they think by owning 20 mutual funds they're diversified. But of course, all the ones that have the best performance typically are going to be from the same category. And it's the category that's really the catalyst for why they did well, not so much that they're diverse and they all just in their own are great funds. So that's one way they tend to buy funds. And the other way is they just go to one company. So you go to one mutual fund company or one brokerage firm or one bank, and you'll have this list of investments. And again, you think you're diversified because you have 10, 15 different names, but they're all from the same entity. They tend to have the same sort of style of investing, so that's not really proper diversification. So I think diversification and asset allocation are oftentimes misunderstood.
So let's talk a little bit more about the picking of the funds, the allocation that you're choosing. I've heard that a good number is 5 to 6 funds. I've heard people say 7 to 10. I mean, in order to be adequately diversified, is there a range that you should have? Does it depend on the size of the portfolio, or how would you tell somebody looking at their portfolio and say you have enough diversification, or that you are properly diversified?
Yeah. So as far as the number of holdings, it's sometimes actually a little more complicated than just that. So a great example would be if someone has a total stock market index fund. Well, they may have 2,000 or 3,000 or 4,000 holdings really, but on their statement it just shows up as one fund. The same could be true of the bond market or anything like that. So it's interesting. A lot of times the folks who think they're the most diversified are the ones who have 50 or 60 holdings in their portfolio, but it's oftentimes individual securities. So they'll have individual stocks or individual bonds. And then some folks who don't think they're diversified because they have, let's say, 5 index funds, they actually are substantially more diversified. They have tens of thousands of holdings, perhaps with substantial global exposure. So there's not necessarily a magic number. It's more so that people understand that there's a little bit more to it than meets the eye. Again, just the number of holdings in and of itself isn't the magic answer. It's really what type of holdings do you have and how well do they play together. And
before we go to break, I want to talk a little bit about the different asset classes that people have to choose among. We talk about large cap, small cap, mid cap. Let's describe that a little bit for the viewer, because I know you run portfolios, and when we return from our break, we're going to talk about how your portfolios are run and how that may be a different approach than a lot of advisors use.
Sure. So you hit the nail on the head. There's a handful of what we'll call just your basic asset classes. So if we start in the most simple, it's going to be stocks, bonds, real estate, commodities, international equities, and those are your kind of core basic descriptions. But if you get a little bit deeper, you're going to find there's different styles of investing, and that's where you talk about growth style or value style. And they're very different. You'll have years where growth stocks, for example, maybe produce fantastic returns while value is either non-existent or even a loss, or vice versa. So an investor's building that properly diversified portfolio, they're not only choosing from all of these different broad market asset classes, but also looking at some of the individual styles that make up a growth investment or a value investment, whether it be stocks or large, medium, small, and so forth. So the composition itself is very scientific if you want to get it right, but doing it right has a lot of reward.
So let me ask another question about, there's a big difference, at least I think, there's a big difference between the advisor and somebody who actually does the research and does the analysis. And the advisor goes about picking things one way, and somebody who actually runs a portfolio may pick things a different way. And let's talk a little bit about those two pieces of the puzzle.
Sure. So I think when we think about like a financial advisor, their role should be to help their clients make smart decisions. So one of those smart decisions is going to be to help them define their asset allocation. A money manager then oftentimes takes over, meaning now that that allocation is defined, the manager is now on an ongoing basis going to work within that framework. So the allocation may be very much based on the client's risk tolerance or an investor's need for income now or later. All of those inputs need to be considered in order to build the right initial portfolio. Obviously then the ongoing management needs to be continued within that framework.
So then the financial planner, the financial advisor, is really the person going out and doing the due diligence, if you will, finding the right portfolio managers or the right mutual fund managers, if that's the case, to allocate his clients to.
Yeah, absolutely. So the advisor has to be the advocate that has more knowledge than their clients perhaps when it comes to things like investing, and really needs to go to bat to make sure that they're doing the absolute best job at defining the right portfolio. There's not necessarily a symbiotic relationship between money managers and investors and financial advisor planners and investors. The money managers oftentimes are one-tracked, so they say, I invest in stocks for growth, and that's what I do. And if an investor happens to go direct, they're not going to get all the value of working with an actual planner or advisor that's going to slow them down a little bit, the client that is, investor, and show them how to do it the right way, which is the risk management and the income planning and all of the other things that come into having a great portfolio.
So, I'm going to make a football analogy. I know your boy plays football. So the financial planner is almost like the coach, and he's the one who has to find all the right pieces to put together the team, and the portfolio manager is like the quarterback or the receiver or the safety in this case of your son.
Sure.
When we return from our break, we're going to talk with Jason about how he creates portfolios. He's got a very interesting approach to this, and I think it could benefit each and every one of you. You're watching The Savvy Investor, and we'll be right back.
Call for your free retirement guide at 1-800-787-SAVVY. Interested in learning more about planning for your financial future? Join Michael Canet, host of The Savvy Investor and best-selling author, in person for an important life-changing financial workshop on the following dates, and start taking control of your future. If you are ready to discover the financial tools and strategies that can help you build the retirement of your dreams, just call 1-800-787-SAVVY today to reserve your spot.
Most of us understand that planning is the key to retiring with the resources and benefits you need. Most of us also don't think about what would happen if a significant portion of these resources were taken away from us before we reached our goals. This can happen through a bad investment, a lawsuit, or even unintended expenses.
As the nation's leading asset protection attorney, this is the area in which I work, to protect the assets you've worked so hard to create so that they're there for you when you need them.
Call 1-800-787-SAVVY.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. Today we're having a conversation about how to create a portfolio that will give you the best chance to experience the retirement the way you truly envisioned. Now, before Jason explains how we make smart money choices, let's take a look at some of your email. Now, from Sam in Dallas, Texas, Sam asks us, if I'm paying an advisor to manage my investments, should I also be paying a manager to manage the mutual funds my advisor recommends? And I think this goes to the concept of fees, right? I mean, because if you're paying an advisor and you're paying a manager, what are your thoughts there?
Yeah, so with all investment decisions, and frankly, it's really true with all decisions we make, even outside of our finances, we want to get a good value. You know, no one wants to feel like they overpaid for something that they didn't have to. But with our finances, I think we have to be especially careful to try to get a good deal because the cost it can have can literally change your life. I mean, It's not like you bought a muffler for $10 extra by having it from a store versus buying it and installing it yourself. I mean, we're talking about the difference between running out of money or having to substantially change your lifestyle, work an extra 3 years. So what's most important is whatever we're doing financially, and this goes without saying, we don't want to pay 5% per year or some outrageous amount in fees. But if it's a reasonable cost, the total cost of a relationship with a professional planner that's also giving you professional money management, and the end result is that you get to enjoy the type of retirement that you really want, that's a great value. So to me, it's not so much a should you or shouldn't you, it's more about the outcome. And I think most people, if they focus on that outcome, it's going to be a lot better for them anyway.
And sometimes I think that when people are shopping the price around, I mean, like you said, obviously you want to get value for it, but sometimes you get what you pay for. Yep. And sometimes the cheapest place to go isn't necessarily the best place to go. Yeah. Sometimes.
I agree 100%.
So our second question comes from Bonnie in Silver Spring, Maryland. And she has a question about stop losses, and she wants to know if stop losses actually work.
Sure. So I guess, a stop loss, for those who aren't familiar with a stop loss, there's a lot of different varieties, but the essential, component is that you set a price or a percentage on a security, and if that security falls in value to hit your stop price, it'll automatically sell. So on the surface, it does work. These have been around for a long time. They only apply to individual securities that trade intraday, so they won't apply to mutual funds or bonds or a lot of other parts of a portfolio. So there are some limitations, and there's also limitations as far as how long they'll last. A common type of stop loss we see is a percentage-based stop loss. Well, most brokerages only will stay on the books for 6 months, and then they fall off. You have to reset it. So it's really interesting. Philosophically, I disagree with the idea of using a stop loss only because it's looking at every individual piece of a portfolio, and then it doesn't address at all how do you know when to reinvest the money? Right. I think that's the bigger issue. A stop loss will allow someone to lose until they liquidate and then never let them know when to get back in. In a roundabout way, the only real guarantee is you're guaranteed to lose something by using it, and I think there's smarter ways to invest in that.
And certainly, if Bonnie's going to use a stop loss, I think an important takeaway from there was that if Bonnie's going to use a stop loss, you want to have a strategy for when you're going to go back in the market.
For sure.
And the other part about it, and you alluded to this, is you can stop loss your way down to zero.
Yeah.
So they are a useful tool, but you have to use them correctly.
Yeah, and really, the tool, I think, is it's a risk management tool. For some investors, that may be fine. For most investors, I think there's better ways to manage risk than that.
So, Jason, when we left for our break, we were talking about asset allocation and things that people should be looking at as they're making their investment choices between asset classes and equities versus bonds and diversification and correlation. But you have a very specific approach on how you do asset allocation and how your firm actually manages money for investors. Let's talk a little bit about what you guys do.
Sure, be happy to. So I think before sharing, I'll go into some of the things we do that hopefully will help your viewers. I think for a little backstory, the idea of our portfolio, so our name is called Formula Folios. It's kind of a mouthful, but the name does tell a lot about what we do. So we really believe in having very specific rules or formulas that we use to help us make smart portfolio decisions, so hence the name Formula Folios. And a lot of that comes from when we look at history and we look at research. I know you are very familiar with these studies, probably some of your viewers are too, that talk about investor returns versus average returns. And it's so frustrating when we see the studies, and they all say the same thing. The markets or the average of stocks, the average of bonds, the average of real estate is always going to be some number like 6, 7, 8%, yet the average investor's down here at 2, 3, 4%. And we can never figure out why that is. So the reason why it is that people tend to buy high and they sell low. You know, no one wants to admit it.
But wait, I thought the whole concept for investors, especially middle America, was to buy at the height of the market
Sure.
and sell low so that the powers that be, the very wealthy people, can actually make the money. Is that the formula that Wall Street has come up with for investors?
Yeah, you know, so I use this, I write a lot, and I use the term the Wall Street system, and
Right.
you know, and it's just kind of like a way to create a boogeyman of why all these problems exist. But I do think it's true. You know, what happens to a lot of investors is they're told they're a failure if they get consistent results. So if we think about investing, it's, you know, the market's up 20%, well, what are you doing this year?
Right.
You know, if you're up 10%, you're a failure. You better go chase that 20% return. So naturally, it's sort of trying to get people to appeal to that greed in their, you know, and then buy something when it's already gone up. You've already sort of missed the train. You know, there's no sense trying to flag it down now. So when we think about the idea of how do we allocate, how do we manage money, one of the very first things we want to do is eliminate all of the emotion from the process. So hence having a sound formula, have it based on academic research, make these decisions non-emotional and mechanical, and we're immediately going to have a substantial benefit because we're going to tune out, you know, the Wall Street
All the
system.
noise.
Yeah.
All the noise,
You know,
financial
which
noise.
is incredibly beneficial.
Right, right.
So, you know, that's really the start, is let's have some defined systems, processes, things like that. Now when we agree that, yes, I'm going to eliminate that noise, I'm going to eliminate all of the distractions, now we actually have to have some good rules. And
Right.
good rules are, sounds easy, not actually that easy in reality. But, you know, most people that are out there and they're trying to make some heads or tails of what would be the right allocation, the smartest possible thing they can do is to meet with a financial advisor. And for our firm, I can say that we only allow investors access to our investment portfolios via a approved, qualified, trained advisor.
And to be fair, that's not unusual for most money managers. Unless you're an institution, most individuals can't go directly to a money manager. I mean, that's just the norm.
Correct, yeah. Private money managers, very much true. Mutual funds, not as much. Obviously, you can open an account at Schwab and buy thousands of mutual funds.
And no disrespect to mutual fund money managers, I don't equate that to the same thing, because you're running
100% correct.
You're running portfolios and you have strategies in place, and it's not that the mutual fund doesn't, but they have a very narrow category of what
Correct.
they can do.
Yeah, and I think that's good you cleared that up, because some people might be confused. Say, hey, well, man, I get access to tons of great money managers. Totally different. A private money manager that's working via a professional financial planner versus just go buy a mutual fund.
Right.
Totally different ball games. But that's the starting point, is go to the right advisor that's going to take, you know, and listen to what it is that you're trying to accomplish. It sounds very simple, and the reality is it is. But you need to have someone who listens, understands exactly what your objectives are. In our case, we take that feedback from the advisor to customize portfolios for each unique client circumstance. The style of money management we use is, you know, most commonly referred to as tactical asset allocation, which means that we define a client risk profile. So each investor is going to have a defined amount of risk that they want to take. There's a number of great tools that we use to help manage sort of that risk so that the risk profile is adhered to. But then the ongoing decisions are made based on these formulas. You know, they're based on very simple rules that we can apply over and over again. So the decisions we make today are the same decisions that we used to, for example, sidestep the financial crisis in 2008, which was something that our firm was very successful in doing. But we didn't do it because we were sage. You know, we did it because we followed rules that gave us warnings to make sure that we shifted the portfolios. And that's what tactical asset allocation really means, is sort of this ongoing shifting from instead of just a static, I'm always in stocks all the time. Hey, look, sometimes it's just not always a good idea to be in the stock market. So we want to have some rules, some formulas in place that help us make those choices.
And I like the fact that you talk about, it's basically a written plan, a written approach based on what the client's needs are, not only their risk, but their desires for their growth. But it combines everything so that they know what to expect, they can measure their expectations. And I think it's also important to recognize that, you know, even though past performance is not an indication of future result, and for those of you who use Morningstar, clearly Morningstar is all about past performance. You know, you do want to look at how the manager has done over the years to see do they have a track record and And do they have a process in place? And that's what I liked when we were doing our research on your company. That's what I liked about it, that you actually have a process that as an advisor you can understand it, and even as a client you can understand that, look, they have things in place to make sure we're doing the right things and it's consistent. When we come back, we're going to do our 3 takeaways from Jason today. You're watching The Savvy Investor. We'll be right back.
If you have questions, drop us a line. Each week, our experts will address viewer mail, and you can email us your questions or go to our website, thesavvyinvestortv.com, and click on Contact Us.
If you're in retirement or retiring in the next 3 to 5 years, you must read Michael Kinnett's best-selling book, Surviving the Perfect Storm. Best-selling author and National Quill Award winner Michael Kinnett's Surviving the Perfect Storm is a must-read to prepare for your golden years. This amazing book can be yours absolutely free, but you must call 800-787-SAVVY. Supplies are limited, so be one of the first 25 callers to receive your free limited edition autographed copy of Surviving the Perfect Storm. Call 800-787-SAVVY.
Today we were joined by Jason Wenk. He's the founder and chief investment strategist of Formula Folios. Jason explained the steps you need to take to evaluate and create a sound retirement allocation. Now, number one of today's takeaways is take the least amount of risk necessary to accomplish your goals. You should be investing in a portfolio that addresses your written goals, not investing for investing's sake. Now, number two, stop loss orders can work. A sound stop loss approach can help reduce your exposure to extreme volatility while you're in the market. And number three, allocation, allocation, allocation. The difference between success and failure just may be in how you allocate your retirement nest egg. Thank you, Jason, for the information. Thank you for joining us, and we'll see you, The Savvy Investor, next week.
Call for your free retirement guide at 1-800-787-SAVVY. Every retiree's goal, from our perspective, is to take the least amount of risk possible to accomplish your goals. Too often, financial advisors and stockbrokers assess your risk tolerance. Just because you can tolerate the risk doesn't mean you have to accept it. Remember, at the end of the day, it isn't how much you make, it is how much you keep. If you would like more information about today's topic, you can contact our offices or visit us on the web at thesavvyinvestortv.com. When you visit our website, sign up for our free weekly newsletter where we give you tidbits each week to help you make smart money choices.